It's now for a closer look at the market. Seema Shah, Chief Global Strategist at Principal Asset Management, looking for, Seema, a different 2024 than what we saw in 2023. I think one of the things that you're pointing out is that investors all year long, 2023, surprised by global growth. A lot of that had to do with the United States and how resilient we were. But a lot of that was due to pandemic stimulus and what we still had remaining from that extraordinary fiscal help that we saw. That's going away.
Yeah, that's right. I don't want to exaggerate the point here because we're not expecting by any means a recession or anything, but it is a slower economic outlook. Just simply the pandemic stimulus is fading. So a lot of the help that consumers, businesses have been receiving. I mean, even if you think about the kind of the Powell pillow, the Fed lending program in 2020, that has enabled companies to refinance, lock in really, really low rates. So they haven't really had to deal with higher rates at all. So we see that maturity wall coming through in about Q2 of this year, of 2024, and that starts to spell a slightly weaker economic backdrop. So that's the difference. That doesn't necessarily mean that markets are going to struggle too much, though.
And China bottoms a little bit. So the 2023 was characterized by not a lot of help coming from China. So that comes back a little bit. You point out that the Fed was able to raise rates quite a bit without seeing the deleterious effects in the U.S. economy. So that has us at relatively high levels where when things are refinanced, and they won't come down that quickly, in your view, because the landing won't be that hard. So it's a different rate environment with less stimulus left.
Yeah, right, exactly. You know, I think we've seen the downturn postponed. I don't think it's been entirely cancelled. And we don't see very, very aggressive Fed cuts next year, certainly not as much as what the market is pricing in. But, you know, I think the key message that we've been getting from a lot of the inflation data, you've just seen it from the UK as well this morning, global disinflation is clearly underway. So there is going to be a pivot. There are going to be cuts next year. It's just not as much as the market is pricing in. And I think that does add potential for volatility in the first half of the year. But once you get those cuts coming through from the ECB, the Bank of England, the Fed, you know, you name it, all of these central banks, then I think risk assets can maybe be on to more of a sustained rally after a bit of a wobble, probably in Q1 of next year.
So maybe we've had, obviously, we've had 3 pretty good months since we've had October lows 2 years in a row. So you think maybe the first half of the year is more of a backing and filling?
I do. So I think there's 2 risks out there. One is just that the market starts to realize that their expectations for rate cuts are a little bit too optimistic. So you could see a bit of a pullback. On the other hand, if they're correct and you're going to see rate cuts as soon as March, that to us suggests that you're looking at a deeper economic outlook, a worse economic outlook than what is currently expected. In which case, the earnings expectations, which is still a little bit optimistic, starts to come into question. Again, you don't exaggerate it. It's really more of a wobble and volatility because at the end of the day, come Q2, end of Q2 of next year, you're still going to see those rate cuts. And any economic slowdown that we've all been fearful of comes through. So at least that uncertainty is behind you. And that slowdown doesn't really inflict any permanent damage to the economy. So there's some relief. It's just that you go through a couple of months, maybe a quarter or so of difficulty before that really sustained rally in risk assets begins.
Will inflation still be front and center in the Fed's, in terms of the policy directives that they institute? They're still very mindful of that it's not over completely.
I think that inflation is going to be almost the only thing that we're going to be talking about going into next year. What we've heard from the Fed is that actually economic growth, you know, it doesn't need to slow in order to see inflation coming down any further. So from here on, the market's eyes have to be entirely focused on what the various inflation numbers are going to do, what's going to happen to shelter inflation, core services. It's really about what feeds into inflation. And as you start to see inflation heading into that 2.5% level, then just from a real rate perspective, it does mean that the Fed should start to cut rates. It doesn't mean that they're necessarily easing and becoming expansionary. It's just becoming that they're a little bit less restrictive and to a more normalized state.